Welcome to the Explainer. Today we're diving deep into the undeniable structural forces that are absolutely driving the crypto market right now. We're going to build out a tactical roadmap for the months ahead. If you've been watching the charts lately, you can feel it. We are at a critical junction, and the data is signaling a massive shift.
Right. So let's jump straight into it with a genuinely staggering number, $1.8 trillion. That is the U.S. budget deficit for this year alone. Just let that sink in. This astronomical figure is the massive catalyst setting the stage for literally everything we're covering today. Because look, as long as this level of capital keeps getting printed out of thin air, it fundamentally alters the long-term trajectory of strictly scarce assets. To make sense of this absolute tsunami of data, here's our roadmap. First, the Bitcoin debasement trade. Second, institutional and smart money. Third, September liquidity and legislation. Fourth, macro cycles and real estate. Fifth, technicals, bull market or trap. And finally, the autumn reaccumulation playbook. Okay, Section 1, the Bitcoin debasement trade and hedging against fiat inflation. So the core problem here was actually brilliantly illustrated recently in a Wall Street Journal ad, which was aimed right at traditional investors. It directly contrasted the rapidly expanding U.S. fiat money supply, which, get this, is projected to hit anywhere from $30 to $100 trillion by 2044 due to continuous printing, with Bitcoin's mathematically enforced hard cap of exactly 21 million coins. I mean, it's a stark, black and white comparison, and it is absolutely waking up sideline capital.
Now, when you combine that endless money printing with the Treasury's plans for massive bond buybacks, we're talking about injecting nearly $1 trillion in liquidity. Well, institutions definitely take notice. In fact, Jeffrey Kendrick at Standard Chartered explicitly declared that crypto is going through its March 2023 moment, basically repeating those massive liquidity injections we saw during that banking crisis. And honestly, this is exactly the kind of environment where a decentralized store of wealth just completely thrives.
Moving on to Section 2, institutional and smart money, and Wall Street's trillion-dollar pivot.
Major institutions are now officially putting their reputations on the line with some highly aggressive price targets, mostly driven by the billions in recent ETF inflows. Look at Standard Chartered. They're eyeing $100,000 by the end of 2024 as structurally underweight portfolios finally start moving in, and a massive $500,000 by 2030 as digital gold. Meanwhile, Kathy Wood at ARK Invest, she sees a generational wealth transfer pushing the bull case to a truly staggering $1.5 million by 2030.
But hey, it's not just about buying Bitcoin. Smart money is actively building the vital infrastructure behind the scenes. We're seeing major platforms like Coinbase integrating the Chainlink network to bring tokenized traditional stocks directly to decentralized finance. This isn't just retail speculation anymore. This is literally the plumbing of global liquidity moving on-chain and unlocking massive utility across the entire Base ecosystem. All right, Section 3, September liquidity and legislation. Let's look at the near-term market catalysts.
So, what's coming up right now? The immediate timeline is packed with precise short-term catalysts. We're expecting market volatility to spike pretty heavily around late August with the Fed's keynote at Jackson Hole and that essential PCE inflation report. But looking just a bit further to September 15th, there's a major legislative milestone on the calendar that could fundamentally shift the entire landscape. We're talking about the Clarity Act. This nonpartisan piece of legislation is viewed by the broader crypto industry as absolutely essential. Impartially speaking, the goal here is to establish the clear regulatory rules needed to protect innovators. And the big takeaway? It could potentially unlock tens of trillions of dollars in institutional capital that's currently just sitting paralyzed on the sidelines, waiting for some actual regulatory certainty. Let's zoom out a bit for Section 4, macro cycles and real estate. We're calling this the 18-year economic telescope. Okay, so according to over 200 years of data analyzed by cycle expert Jason Pizziano, the U.S. real estate cycle historically peaks right around the 14-year mark of an 18-year broader economic cycle. We saw this in 1989 and again in 2006. That math places us squarely at the top of the current cycle right now in this 2024 to 2025 zone. Understanding these global property trends, like, for example, the sharp top-end corrections we're already seeing in places like Australia, is absolutely central to assessing long-term capital preservation for November and beyond. So what does this all mean for us? Well, the crucial point is this. Even if real estate is topping out right now and credit is tightening, Historical data proves that risk-on assets, like stocks and crypto, usually have a delayed reaction. They can actually continue to run aggressively for another 12 to 27 months after the real estate market peaks. So we've got a window before we see a massive macro correction.
Bringing it back to the present, Section 5, Technicals, Bull Market or Trap. Let's read the charts with Gareth Soloway. So recently, $4 billion, yes, billion with a B, in short positions were liquidated. And of course, that naturally forces prices up artificially. Top traders are now asking this exact question. Did we actually establish a fundamental higher high, or was that recent push up to 81,000 just a massive mechanical short squeeze that's going to fade? According to Gareth Soloway's incredibly strict analysis, we really have to respect the charts here. We just rejected off the underbelly of a key historical trend line, and it left behind these huge candle wicks signaling heavy selling pressure right near $81,300. Until we check off three specific technical requirements: 1, breaking the $82,830 pivot high; 2, confirming a weekly close above the 50-week moving average; and 3, closing September strongly above $74,000, well, the chart is technically still making lower highs and lower lows. So honestly, a pullback is highly probable before a new parabolic run begins. Soloway has this great quote: "By having the odds in your favor, you actually become the casino. You remove the emotion and let the data talk." I just love this analogy. It reminds us that technical analysis isn't about gazing into a crystal ball to perfectly predict the future. It's about trading based on, say, a 75% mathematical probability, rather than getting emotional about whatever the latest hype on Twitter is.
Finally, Section 6, the autumn reaccumulation playbook and how we're navigating the pullback.
All right, so if that pullback happens, here are the target zones. If you're an aggressive trader wanting to bid early, the $71,000 to $73,000 range is a fantastic, healthy reaccumulation bounce zone for a slow, sustainable stair-step upward. But if you're a bit more conservative and you're waiting for high-conviction structural support, that $67,000 to $69,000 zone is just beautiful. It perfectly aligns with the retest of the critical 200-day moving average. And keep in mind, October has historically been a pivotal month for exactly these types of cycle shifts. Historical patterns show us over and over that sticking to a simple procedure is the most reliable way to position yourself. First, stop trying to catch the absolute perfect bottom. It's almost impossible. Instead, use a dollar-cost averaging or DCA strategy through the second half of this midterm year. Doing this completely removes the emotional stress of the day-to-day chop. You can just patiently wait for those big legislative and liquidity catalysts we talked about to officially confirm the macro breakout. As we wrap up this explainer, I want to leave you with a final, pretty serious thought. The structural imbalances in the fiat system are literally only growing, and massive institutional liquidity is just waiting at the gates. So are you going to risk getting left behind trying to time the exact local bottom, or are you strategically preparing yourself for the largest transfer of wealth as global fiat debasement accelerates? It's a big question. Thanks for tuning in and stay focused out there.